Welcome to Analyst's Estimate. We bridge the gap between Wall Street and Main Street by breaking down complex investment research so you don't have to.
Disclaimer. This podcast is for educational analysis, not financial advice. AI powers much of our research, but AI can make mistakes and data can occasionally be inaccurate. Treat this as a business analysis rather than deep company research. Always do your own due diligence before investing.
Today, we're doing a critical deep dive into Kaynes Technology India Limited. That's KNES on the NSE. And our mission today is to unpack a really stunning paradox.
It really is a paradox.
How can a company be posting 51% year-over-year revenue growth, and yet its stock is down nearly 45%? We're looking at the one report that really explains why Wall Street is kind of looking past those amazing operational numbers and focusing on something else entirely. Governance friction.
That's the perfect way to put it. The Kaynes story right now is all about that friction. I mean, if you just look at the operations, this is a 38-year-old leader in electronic system design and manufacturing, or ESDM, and their performance is just stellar.
They're riding that whole Make in India wave.
Absolutely. They are capitalizing on India's push for self-reliance in electronics beautifully.
Okay, so let's start with the numbers then. Walk us through the financial health for the full fiscal year 25.
Right. So for FY25, revenue came in at 2,722 crore. That's that huge 51% year-over-year growth you mentioned.
Incredible.
It is. And EBITDA margins have stabilized at a very strong 15.1%. We'll definitely come back to that number. But I think the most impressive data point, the one that points to the future, is the order book.
And that stands at?
As of the second quarter of fiscal 26, it's a whopping 8,099 crore.
Wow. So that's, what, 2 years of revenue?
More than 2 years of revenue already locked in. The visibility is just fantastic.
So based on everything you've just said, we should be talking about a stock that's soaring. But the reality is a year-to-date correction of 42% and a 45% drop from its peak. If the business is so healthy, where's the friction?
The friction points, well, they're entirely concentrated in investor confidence and, frankly, disclosure quality. It really all boils down to two specific, very material issues that were flagged.
Okay.
First, there was a highly critical report in December 2025 from Kotak Institutional Equities that raised some very pointed accounting concerns. And second, you've got this lingering uncertainty from a SEBI show cause notice back in March 2025.
So performance is completely decoupled from valuation because of institutional risk.
Got it. Okay, let's unpack the business itself then, because the foundation here sounds really compelling.
It is. Kaynes isn't just some simple assembly line. This is an integrated electronics manufacturer out of Mysore, serving over 350 customers across 6 different verticals.
And their whole strategy is to move up the value chain, right?
Exactly. They are explicitly moving up the margin curve. While they have a strong base in, standard OEM assembly, the future valuation, the whole story, it lies in these huge strategic shifts. We're calling them their CapEx moonshots.
And by that, we mean they're getting into semiconductors directly. This isn't just a small step, it's a huge structural change.
Precisely.
2 major projects. The first is what's called an OSAT facility. That's outsourced semiconductor assembly and testing in Sanand, Gujarat.
That sounds expensive.
It's a 4,300 crore investment, and it's backed by some crucial government incentives. The goal is a capacity of 6.3 million chips per day. The second big project is a high-density interconnect PCB manufacturing plant in Chennai.
Okay, hold on. HDI PCB, can you break that down for our listeners? Why is that distinction so important?
It's critical. It means they can manufacture smaller, much more complex circuit boards for really high-end applications. Think servers, advanced medical devices, sophisticated avionics.
So not the board in your toaster?
Not at all. This is complex technology with very high barriers to entry. And that Chennai plant alone is a 14 billion rupee CapEx project set for completion by fiscal 28. This is the difference between being a generic supplier and becoming a specialist architect for these mission-critical systems.
And that technical superiority, that's their competitive edge. The analysts call it a digital toll bridge in Indian ESDM.
That's a great way to think about it. And you mentioned mission-critical. That's where all their certifications come into play. Kaynes holds 10 global certifications.
The most in the country, I read.
The most certified ESDM company in the country. This is what lets them target those high-reliability sectors, aerospace, defense, railways. So when a customer in railways needs the Kavak train protection system, they need a supplier with certified expertise. It creates these really sticky, customized contracts where the tech certification is just a massive barrier to entry.
They're escaping the price wars of consumer electronics.
Completely. And you really see that shift when you look at the historical financials.
Right, let's look at that growth from fiscal 22 to 25. The numbers are, well, they're pretty amazing.
They are exceptional. Over those 4 years, you saw revenue grow at a 61% compound annual growth rate. EBITDA was right there with it at 63% CAGR. But the real engine was the profit after tax. That grew at a stunning 90% CAGR.
So this wasn't just revenue growth, they were getting more profitable as they got bigger.
Exactly. They leveraged their scale. The net margin went from 5.9% in 22 all the way up to 10.8% in FY25.
And that 10.8% net margin, that's the key, isn't it? That's why the market gives them that premium valuation.
It is. They are effectively capturing 4 to 5 percentage points more value on every single rupee of revenue compared to peers who are stuck around 6%.
Yeah.
The market pays a scarcity premium for that.
But there's always a but. That aggressive growth, that massive investment, it comes at a cost, and we see it in their capital efficiency.
You're talking about the return on capital employed, or ROCE.
Yes.
If you look at the tables, ROCE has structurally declined. It went from 24.4% in FY22 down to 18.5% in FY25.
Which looks bad on the surface.
It does, but this isn't a sign of failure. It's a direct consequence of their strategy. All that aggressive CapEx into the OSAT and PCB facilities, it's locking up capital and assets that aren't generating revenue yet. They're sacrificing short-term returns to build for tomorrow.
Okay, so this brings us to the really critical flaw the research identified. This is the big aha moment, the massive gap between those paper profits and the actual cash coming in the door, the cash flow paradox.
This is where the whole investment narrative really changes. It's their primary operational headwind.
Yeah.
So despite generating a very healthy profit after tax of $2,934 million in FY25,
Yes.
the company reported a negative cash flow from operating activities, CFO of negative $820 million.
Wow, so they made nearly $3 billion in profit but lost $820 million in cash from operations.
That gap is monumental. And as a result, the free cash flow for FY25 was also profoundly negative. It clocked in at negative $8,944 million.
Negative operating cash flow despite record profits. I mean, for an analyst, that's a huge alarm bell, isn't it?
Yeah.
What is tying up all that cash?
It's all locked up in net working capital, NWC. The cycle spiked to 132 days in FY25, which is way above their target of under 90 days.
And that's driven by what? Inventory?
That's part of it. Inventories are high, over 9,124 million. But the critical piece is the extended receivables.
Are their customers just not paying on time?
It's more structural than that. Management points a finger at a big chunk of it, about 326 crore in non-current receivables coming from their acquisition of Iskrameco India, the smart metering business.
Ah, government contract.
Exactly. Government contracts in smart metering often have these very long, annuity-like payment terms tied to project milestones. So Kaynes is booking the revenue up front, but the cash collection cycle is just fundamentally longer. So their biggest growth driver is also their biggest cash drain right now.
That is a tough spot to be in. The report also flags something else, another subtlety about their profits that pointed to, let's say, less than optimal capital deployment.
Right, the other income flag. When you look closely at the income statement, you find that a huge portion, over 36% of their fiscal 25 profit, wasn't from their core business at all.
So where did it come from?
It was interest income, specifically 1,069 million of it.
Interest income on what? They're not a bank?
It was interest earned on their QIT funds. Money they raised from institutions that was just sitting in an account, temporarily parked and unutilized. The report notes that over 8,200 million of those funds were just sitting there.
So a third of their profit came from a high-interest savings account, essentially.
In essence, yes. And that flags an efficiency problem. It suggests they're great at execution on the factory floor, but the planning and deployment of these huge capital raises might be lagging a bit.
Okay, that whole narrative shift brings us right to the elephant in the room, the governance and regulatory headwinds that actually caused the stock to correct in the first place.
And these are material issues. You have to look at them head on. First, there's that SEBI show cause notice from March 2025. It was issued to the Executive Vice Chairman, Ramesh Kunhikanan, over an alleged violation in maintaining the structured digital database for insider trading.
And that's still unresolved.
It is. The company is preparing a response, but that kind of uncertainty is just toxic for institutional investors.
But the real bombshell, the one that the Kotak report focused on, was about related party disclosures, wasn't it?
That was the most damaging governance failure identified, yes. The company acknowledged what they called an inadvertent omission.
And that omission was?
180 crore of purchases from a subsidiary Kaynes Manufacturing, was left out of its standalone financial statements. Now, to be clear, these transactions are eliminated at the consolidated level, so the final bottom line is correct. But
But omitting them from the standalone disclosure is a huge red flag for internal controls. Why does that matter so much to the market?
it matters because it fundamentally undermines confidence in their audit process and the clarity of the core business. I mean,
Hmm.
if you can inadvertently omit a 180 core purchase, which is huge, it just raises serious questions about the maturity of your back office.
Hmm.
It suggests the processes are lagging way behind the manufacturing scale.
And on top of that, you had a lot of management turnover.
Right. You saw Ramesh Kunikanan move roles, a new MD appointed, and the CEO resigned in September 2025. That kind of churn during a period of massive capex and regulatory scrutiny, it just adds another layer of risk.
So we have this premium business, fantastic growth, but it's held back by these really significant governance and cash flow risks. Which brings us to the valuation. How do you even value a company like this?
Well, that scarcity premium is real. That's because of the superior margin quality. The PE ratios is high, no doubt, 137 times based on FY25 earnings.
That's steep.
It is, though it's projected to fall to a more palatable but still aggressive 75 times for fiscal 26 estimates. The market is basically betting that the growth and margin quality will win out in the end, but it's demanding a discount for all this risk.
And that bet is really underpinned by that massive order book.
Precisely. That 8,099 crore order book is the floor. You've got key growth verticals like auto and EV set to contribute 5 to 6 billion by SY27. You have the railways business with CAVAC. I mean, if they successfully commission their CapEx plan, the growth is structurally locked in.
So what's the final call? What's the recommendation here for an investor trying to navigate this?
Look, the final assessment is very nuanced. It has to be. For a conservative investor, the recommendation is a clear hold or avoid, at least until there's clarity on the governance and that working capital cycle normalizes. The valuation is just too high for the risk.
But for an investor with a higher risk tolerance?
For a high-risk growth investor who believes in the fundamental business, the report suggests to accumulate selectively on weakness, specifically in the 4,200 to 4,500 rupee range. That range provides a bit of a buffer against these immediate institutional risks.
Okay, so for anyone watching this stock or maybe thinking about accumulating, what are the absolute must-watch metrics over the next few quarters? The things that will tell us if management is getting its house in order.
You have to track 4 specific things. First, the Q4 fiscal 26 results. And you're looking specifically for improvement in net working capital days. They have to get that number trending back below 100.
Okay, what's second?
Second, the outcome of the ICRA credit rating decision. They're currently reviewing the company's internal controls. Third, you need a final official resolution to that SEBI show cause notice. And fourth, you have to track the actual commissioning timelines for the OSAT facility. Any delays there will derate the whole growth story.
It seems like this whole deep dive shows that Kaynes Technology is a quality business that has just fundamentally outgrown its back office. The key question isn't whether they can build things, it's whether these governance issues force conservative money to just wait on the sidelines no matter how good that order book looks.
That's it, exactly. For this stock, governance isn't just a checkbox. It is the ultimate gatekeeper to a higher, more sustainable valuation.
A fascinating and cautionary tale.
Thanks for tuning in. Remember, this isn't financial advice, and since we utilize AI, always verify the data yourself. See you next time.
Welcome